rupee has weakened. I think it's been one of the big topic in the market about the rupee. Those who are actually not exposed to rupee also, this has become a limelight because we hit close to 95 and there was a talk that we might hit 100, right? So one of the important avenue for NRIs, right? This is a very good window we consider for NRIs to increase exposure to India, and I'll share some perspective on that. The first slide is this is USD dollar INR chart. This is basically a monthly. If you have to look at this is a close to a 4-year return. 2022, 2023, rupee depreciated sharply. We moved from 75 to close to 83, right? So this is the time where straight 10 to 12 months we had a rupee depreciation. But what is interesting, which people forgot in this crisis, is from 2023 2025, approximately 2-year window or maybe a 1.5 year type of a window, we had a rupee which was primarily traded between this 83 to 85 band, right? So it went up, it went down, extremely tight zone. And post or the early part of 2025, the rupee broke down, and today we traded close to 95 to 92. So this was a steep fall, we agree, but we have to see this in the construct of we had a time period of a no depreciation. So actually what happened, since you depreciated less and you got overvalued, and with this crisis came up where we got exposed to oil crisis, the rupee fell very sharply and adjusted back. So the way to think about is rupee depreciating around 3-4% was normal. Since for a 2-year period between 23-25 it did not happen, the 25-26 early window became a little more turbulent. Definitely it was scary, but I think we need to see given the construct in which it behaved in the past. The one thing which I want to highlight very clearly is about we are not as badly positioned like what we were the previously. And I want to reflect on one tenure of the market, which was a very vulnerable for those investors who stayed for last 10-15 years, is the taper tantrum, which is 2013, right? Where rupee depreciated close to 21% very significantly. I want you to look at two data points. One, if you have to look at our current account deficit, which used to be very high at 4.8%, right? Which was a reflection of a very vulnerable external situation. And if you have to look at our overall rupee depreciated also close to 21%, inflation was very, very high, close to 10. So in the past crisis, we had high inflation, high current account deficit. That's where the policy rates were trading close to 8%. If you have to look at current crisis rate, which is about to end in some form, the rupee depreciated a bit of 4% on the crisis. Obviously, before crisis also rupee fell sharply, which I commented. But if you have to look at a CAD, our current account deficit is close to only 1%, and our inflation is actually very, very benign. Obviously, this number will improve. The whole point is when we say macro construct is better than the past, I think we need to look at this data and see we are not in a very, very bad position. That's why, as an allocator of capital, we were consistently positive on the market, saying, I think we were a little vulnerable due to oil, but at a broad construct level, today we are in a far, far better wicket than in the past crisis. The second data to support why, how to think about this CAD is, so I'll give you one or two only metric, which gives you a very good idea. We are basically a 4 trillion economy. We import close to 800 billion. This is the number which we need to remember. In that, oil is close to 200 billion. So when a 200 billion item moves up by 20%, you will add up $40 billion. So every $40 billion is 1% of the current account deficit. That's all number. So when the oil moved up sharply, the market felt current account deficit will come to 2%. And if it rises further, it go to 3 or 4%, right? That is where the panic got set in. But now oil has already clumped close to 90, which is also not a very conducive zone, but actually reasonably acceptable zone. We clearly see we will end up a current account deficit of 1 to 2%, which is not a very healthy scenario, but not a very vulnerable scenario. So this is where the rupee has depreciated significantly. The broad take is, I think the worst part of the rupee is reasonably done. From here, broadly, our thinking is it should be a little more stable rather than depreciating very fast. So if you have a long-term capital and always want to allocate to an growing market for next 10, 20 years, which is India, I think probably this could be one better time to allocate reasonable capital to Indian markets.